All right, what's up, everybody? Welcome to this month's first Saturday. Technically, I guess the second Saturday of the month. But this is going to be a monthly thing that I do here on the Discord server, as well as posting it, bits and pieces of it, I guess, on the YouTube channel. So we're going to be talking about trading challenges, successes. Second part of it is going to be a Q&A session for about 30 minutes. And then the last session is just going to be some fun risk-free poker. So hopefully y'all are as excited about this as I am. Let me actually make currently the only person in the chat, but hopefully some people come in. So I'm going to start out by talking about my trading challenges and successes. But I guess as a preface, I should probably say why I haven't posted any video for the last 8 months. So I've been working in private equity for, I think, 6 months since October, November, somewhere around there, around my birthday. So pretty exciting time. And working 8 hours a day doing that, as well as currently studying for my first CFA test. So that's, an extra 4 or 6 hours a day, depending on how motivated I am or how much brain power I have left. So yeah, haven't had much time to post the strategy videos over the past 8 months, just because it consumes a ton of time. Strategy videos for me usually take like 8 hours just to edit, on top of probably 4 hours or so to come up with the idea, write it out, record, etc. But anyway, welcome, Ohm. Thanks for showing up. So I guess the first challenge that I personally have, that I'm sure a lot of y'all might have, is I don't have a ton of time in order to trade like I did previously. Whenever I was making YouTube channels, I could kind of work whenever I want, but now working 8 hours a day, kind of have to trade in smaller time frames, usually like 30 minutes, as soon as the bell rings, just because that's the most volatile time to trade. So if I want to make any day trades, I can do that. But of course, if you're only trading in a 30-minute time period when there's an 8 hour trading day, I think 7.5, but regardless, um, there's a lot of volatility, especially in options trading. So you're not going to get the exact best return if you're trading in a smaller time frame compared to the entire day. So that's been a bit frustrating. One way that I've tried to mitigate that is by using longer dated options. And especially if they're out of the money, they'll have a low delta, and the longer time frame means that they'll have a lower theta. The theta will eat up more of the options contract since it has a lower value, which, that is a trade-off. But if you choose super deep in the money option, then for every dollar that it moves, you're going to have that much more gain or loss. So, you have a 90 delta and the stock goes up or down $1 in a day, then you can make or lose $90 based on it. So personally, I've been using a lot of out of the money, longer dated options. Typically, I would say, well, depending on my time horizon for the trade. One trade that I'm in right now is based on banks potentially having some havoc in the middle of this year. So I do have one for, I think, June, expiring in June. And then I have one also expiring in December. So a little bit of diversity there in terms of expiration. I think we're going to get hotter inflation this summer than most people expect, which is probably going to hit the banks pretty hard. Interest rates will go up. And I think that'll probably have some impact on commodity prices, gold prices, stuff like that. So, yeah. So I've tried to mitigate that risk of not having enough time by extending my expiration dates. And sometimes, I will take a day trade if I'm feeling up to it. But in that 30-minute time frame, if you don't have the stock actually make any decent move, you could just end up flat, or depending on how short the expiration is, if it's the same day or just a couple days out, then you can have a decent amount of time decay in that. So it is a bit frustrating being limited on time, but there are some ways that you can try to work around it. Welcome, Ken and y'all can type in the chat here if you're able to see it. Hey everyone. I'll actually type everyone in here. Ping everybody for the millionth time today to get. But yeah, with some of the challenges that I faced, I've been doing okay in the market, mostly flat, because a huge part of my portfolio is in Tesla. Right now, they're experiencing a lot of political volatility, very similar to Google and the whole movement that they had. So, the thing about these big tech stocks, in my opinion, is yes, you are going to have this political volatility based on DEI or based on Elon Musk being who he is, extreme conservative. There's going to be people that don't like that, but at the end of the day, the government has to support them. So I'm still, good morning, Peter. Welcome. Government at the end of the day still has to support them. So big tech basically runs this entire economy. So I'm sure that Elon Musk, Google, they're going to get bailouts. And currently long on those positions. But yeah, some successes I've had in the past couple of weeks. I did make a decent amount shorting Google because of the DEI stuff that was going on, and just based on sentiment, following the sentiment. It did take a couple of days for that to pay out, but that was probably 100, like a 50% return on that, and then another return that I've really been successful in is investing in robotics. I invested in a ETF called BOTZ, or ticker symbol BOTZ. I started accumulating it, I think, 3 months ago at this point, and my reasoning behind that is I feel like artificial intelligence, AI, the valuations are pulled too far forward in my way to kind of mitigate that and also quasi invest in it in a way, if that's the right word, was to invest in robotics because they share synergies together. So, since they're related industries, one is going to benefit from the other, and I feel like robotics is more undervalued than the AI space. And I have been thinking about going into virtual reality investing. I think that virtual reality could have some really big impacts personally. I work at a firm that only has probably 5 or 6 employees, and I'm sure that we pay, $2,000 in rent just because we're in the city or near the city, and commercial real estate prices still haven't come down. So for these smaller firms, I feel like it would be beneficial to have like an online office, I guess, is what I'm thinking, right? If you can buy 5, 6 Meta Quest for $600 a piece, it's like 2 months of rent. So you're not going to have the same face-to-face interaction, of course, but at this point, it's almost there, I would say. Like if y'all have ever watched the interview with Lex Friedman and Mark Zuckerberg, it's pretty interesting. So yeah, I gotta miss me terribly. Yeah, it's been mutual. It's a tough job what I do, but private equity is definitely a lot different than what I was doing previously, but I think it's pretty exciting, honestly. Like I get to solve challenges that I wouldn't face otherwise, and that's really all I'm for is solving the biggest challenge I can find. Maybe to the detriment of my mental health sometimes, but it is what it is. But yeah, I guess that's my challenges, my successes. I'll open the floor up to everybody else. Peter, Ken, Ohm, if y'all want to either speak on the mic if you're comfortable with it, or just share it in the chat. Just go to this little button, open chat, and then you can share that. Um, in order to talk, if you want to, I think you have to press the space bar. But yeah, Oh, I guess another struggle that I've been having, personal struggle, has been losing weight like crazy because basically always working. Don't have much time to eat, so my cheekbones are more pronounced than usual. That's why. All right, looks like we don't have many people typing in the chat. But let me open the floor up in the general chat. What have been your trading challenges and successes over the past month? For me, it's been making enough time for trading and the volatility that comes with the nature of options. Probably reformat that to make it look nicer, but yeah. But yeah, after this little next 15 minutes, we'll move on to options Q&A. I think I can change this. Yeah, status. Discord's been making some really decent progress in terms of streaming, which has been nice. Still has a huge bot problem of people spamming and trying to scam in DMs. Very common. Really annoying. But that's the cards we're dealt using Discord. Wish that I could use Twitter, but don't really have much of a following over there. But Twitter, X, the process to sign up for it is so difficult at this point to where a bot's not going to try to figure it out. It takes way too long. No responses in the chat. It's okay. Well, if we don't get any responses, maybe in the next couple of minutes, we'll just switch over to Q&A. We can maybe shorten this a little bit. Or maybe I should just put the poker session in the middle. I feel like that's what people really come for. To have some fun. Make sure that my OBS is still recording. Yep, cool. Maybe I can start going through some YouTube comments that people have been asking questions. It might be a little bit useful. Just some. YouTube Studio. Mm, it's not my YouTube studio. There it is. Oh, yeah. My YouTube channel just turned, what is it, 3 years old? I started, 4 years old now. Started in 2020. Let's see though. Comments. So, what is the difference between the ghetto spread and the bull call spread? Bull call spread would be a debit spread where you're buying and selling the options with different strike prices and the same expiration date at the same time. The ghetto spread, termed by the trading fraternity, is whenever you buy a call option at one point in time with the whatever strike price you choose, and then you sell a call option with a higher strike price at a later point. So it's really about the timing of when you sell the option with the higher strike price. Still wrapping my mind around this. What app was used? Most of my videos, especially my short videos, were using Robinhood. I have switched over to Thinkorswim just because it's a lot easier or a lot quicker to navigate than anything. It's more complex, especially for new traders. You could always consider Tasty Trades. It's very similar. It's a little bit more beginner friendly, but um, yeah, Robinhood's definitely the most beginner friendly. But it does take longer to actually execute trades, which is the downside of that. I know this video is 2 years old, but what about if I bought options when a stock was low that I'm bullish on and think it has long-term growth? Now, just before the expiration date, the stock has gone up, and I believe it's going to continue to be successful. One should just exercise to own the shares. So this is, I'm assuming, talking about leaps options. The reason why you don't want to exercise leaps options generally is because it has so much time until expiration, it's going to have a lot of extrinsic value. Extrinsic value is just the amount of time value and volatility of the stock. The more time that the option has and the more volatile the stock has, the more it's going to increase the premium. So you have intrinsic value, which is just the difference between the strike price and um, the trading price for the stock, only if it's in the money. So if it's a call option, in this case, if the stock is trading above the strike price, that is the intrinsic value, the difference between that. And then the extrinsic value is the addition of time and volatility. This person asks what happens at the money. I'm assuming he's talking about at expiration. In that case, if it's at the money, then it will be assigned for a short put option. So, say you have a stock trading at $100, your strike price is $100. Exactly, I think it's at exercise at like 11:59 p.m. or something like that. So at 11:59, if it's trading exactly at the same strike price, it is going to be exercised by the person who bought it, which means that the shares are going to be assigned to you. You're going to have to buy those. And if it's at the money, that means you'll have the highest amount of time decay or the quickest amount of time decay. So you will be realizing more and more of that credit a lot quicker than if it's in the money or out of the money. What if you sell covered calls at a higher price, and if it reaches, you're forced to sell options at a price, would you profit? plus premium, but you're shaken out of the position. If you sell a covered call at a higher price, reaches the price that you're forced to sell, which you profit plus a premium, but you're shaken out of the position. So if you end up by shaking out of the position, I'm assuming that you're going to buy it back because you don't want to lose your shares. And in that case, depending on how quickly it moves, you will have to buy the option back at a higher price, which means that you would take a loss. So say an option goes from $1 whenever you sell it to later on before the expiration date, $1.50. You take the difference between those, 50 cents, multiply it by the 100 shares, you would take a $50 loss because you're buying it at a higher price. So it's kind of like shorting stocks, where you want to sell high, buy low, but if the opposite happens where you sell low, buy high, you will take a loss. How do you explain max loss unlimited for covered calls? For cover calls, the reason why it's unlimited is because you can potentially lose the shares, and the shares can go much, much higher. So, for example, for me, a loss that I've not lost, but a potential gain that I could have had was AMD. 2 years ago, I think 3 years ago at this point, sold cover calls on AMD. It was trading at I think $80 at that point, and now you look at AMD, it's trading at 200. So that's $120 of value that I missed out on essentially. Well, I guess $1,200. No, 120 times 100 would be $12,000 that I missed out on. So yeah, that is the risk, or one of the risks of cover calls. And then you have the downside risk of owning the shares continuing to come down. So let's say I buy AMD at $100, now is trading at $50. That's a $5,000 loss that I took on the shares, which you can kind of mitigate with cover calls by collecting that income in, but it's not always going to make up for the entire loss. What if you can only sell if you buy puts? Way too high to understand this. What if you can only sell if you buy puts? Not sure what that question is. 750 in a single hour. Uh, yeah, I mean, variance increases with returns, so you will have 750 days like I had here, and then sometimes you'll have $1,000 losses. Not easy, but that is just the nature of risk and reward. Is you will have negative skew in trading to where your losses, especially with these high volatility options, will be larger than your wins. Most likely, that's just the statistics behind it. What is the difference to the ghetto spread? I think we already went through these. Yeah, nothing is worse than a widespread. Amen to that. Learn nothing about the housing bubble. Oh man, I think that we're in much deeper problems in the housing bubble. That is obviously just an opinion of mine, but I think that commercial real estate is going to have a massive, massive impact on banks' balance sheets. Because right now, there's a ton of unoccupied space due to the shift from the office to work from home and more people trying to push uh, to work from home. I mean, personally, I think that it's better to work in an office because you actually get more collaboration that way. Like if you're trying to email somebody, it is the most frustrating experience ever. And of course, you do get a lack of productivity driven by maybe people just chatting with each other. But I feel like it also enables more collaboration. Like something that I'm very good at is having like a long-term vision. Something that one of my coworkers is good at is kind of breaking that vision down for me to piece it together. So being able to actually be in the room with him and write things down rather than going back and forth an email and taking days to get things done is just so frustrating. I'm curious what the productivity levels have been, like pre-COVID versus post-COVID, and the whole work from home movement, and how that's going to continue to impact productivity and GDP and all of those measures. What else we got? What do I prefer, cover calls or collar spreads? Collar spreads are good if you think that the stock is going to go down significantly. Cover calls are more so as you think that the stock could be overvalued and might either retrace a little bit or stay flat. So each of them kind of has their own advantage. Something that I would probably use a cover call on, or sorry, a collar spread on right now, would be Fulgent stock, because their management has been selling for God knows how long at this point. I have 120 shares that I'm at a pretty deep loss for. So I don't necessarily believe in the company as much as I did when I initially invested in it. So if I think that it's going to continue to come down, then collar spreads would work better than cover calls. Good example for a cover call right now, though, would be like BOTZ, the ETF, the robotics ETF that I invested in, where I think that it's going to go up long term. I think that right now it's a little bit overextended. So I wouldn't mind selling my shares at the new higher price right now. I think it's at like a 13 or 15% return for the past few months. So eventually it's got to come back to the mean. It's pulled a little bit too far forward. So I feel like a covered call would be better in that case. And again, the collar spread would be better if you invested in the stock and now you don't believe in it as much anymore, if that makes any sense. Or you could just, sell the shares outright, but you don't get any money for that. You don't get any income from that, I should say. Who's going to buy such a put? For selling puts, they either have to sell at a low price and give you the money. The person that's buying the put is just any regular put buyer. They either have to sell at the low price and give you money. Not sure I understand this one too much. But yeah, somebody just joined us. It's Ken back. Welcome back, Ken. About to have the Q&A session starting in 1 minute. Let me change this. Options trading Q&A. Options Q&A is starting now. I should probably link this. Jesus Christ, god dang. Oh, just want to edit this. There we go. So yeah, if y'all have any questions for me about options trading, either Peter or Ohm, you can either type it in the chat, speak it out loud, whatever you're most comfortable with. House plus computer plus gains equals money. Does that mean like mortgage plus computer plus gains? Welcome. Yeah, options Q&A is starting, so if y'all have any questions, you can either speak them out loud or in the chat here. See if there's any questions I can answer. Ah, hi, Yuma. If y'all have any questions, I think it's push to speak, so just use the space bar, and I think you should be able to talk that way. Or you can just type it in the voice chat over here. In the meantime, while I'm waiting for that, I'll try to see if anybody has any questions here. Thoughts on Oxy? I think that right now, oil especially could be undervalued given the inflation that I'm expecting for this summer. So I think Oxy could be a good play for right now. I think that, usually demand for oil goes up during the summertime because people are traveling more, people are spending more, the economy is typically doing better. So oil, Oxy, I'm personally invested just a single share, I think, so not a ton, in XLE, just the energy ETF. So let's see how to negotiate on Schwab fees. If you want to negotiate with any broker on the amount of fees that you pay for options trading, you usually have to have a lot of money for one and then trade a lot of volume. Because they're not just going to give it to any average Joe, because that's how they make their money, is they make money on the 65-cent fees that they collect every time that you buy or sell an option. Which you can mitigate by trading with something like Aries, or you can trade using Robinhood. It's a little bit. Aries, I would say, is okay. But Robinhood is just so slow to trade. So, again, not my favorite platform. Thinkorswim's still my favorite. I'll pay the 65 cents just for the quickness of being able to trade. Do I have a girlfriend? Yeah, I am married with a daughter. Oh, and something that I really need to work on is the trades that I make. So these are the trades that I make, and I've made it open to anybody to be able to watch now with the premium Discord being free for the next few months. But um, this is kind of a mess, honestly. So if anybody knows how to maybe parse this message, I'm currently getting it from Zapier, an email that's sent to Zapier. And then that gets moved to this chat here. So if anybody knows how I could possibly parse that information in Zapier to make it more legible, maybe something like this rather than, again, this jumbled mess, that would be super useful. But let's see what else we got. Any newbie questions recently? Try to butterfly spread on Robinhood options. Now they're going to let it expire in the money. They're all going to expire in the money. So what should I do? So if all of your spreads are going to expire in the money, then you don't have to do anything necessarily. You just, well, it depends, I guess, on if you're short or long on it. You're just going to realize the max profit or the max loss. So you are going to be assigned and exercised for the options that you're holding, but the way that it works, if you have a margin account, it's going to balance all of those out for you. Your broker is going to do that for you, so you don't have to worry about, being on a line for thousands of dollars depending on what stock you're trading. New to options trading, what percent per month could I reasonably expect to make? That's the thing about trading in general, is that it's never going to be consistent, because in order for it to be consistent, you have to have a consistent market. And if you have a consistent market month after month after month, the profits are going to end up diminishing because it's predictable. So there's no real percent profit that you can expect per month. It's always going to vary. But yeah, how do you put a stop loss for an options trade? Depends on the broker you're using. Robinhood, I forget how it works for Robinhood, but if you're using the Thinkorswim platform and you have the active trader situation, I really wish that I had my Thinkorswim open right now. But if you're using the active trader, you can actually go below um, the current price of the option and then just click on the sell side. So say I have an option that's trading for $100 and I want to set a stop loss for 50. I would just scroll down the prices on the active trader, click on 50 um, on the sell side, and that would set my stop loss for me. That's the easiest way to do it on Thinkorswim, at least. Hello. We've got to how to set stop losses for selling puts. So again, if you're using Thinkorswim, obviously you would originally sell the option, and then you would scroll up the option or scroll up the prices, and then set a higher price for the buy that would be equal to your put. Let me open my Thinkorswim because it's easier to visualize it than to actually speak it. And once this loads, let me cut my screen right quick so we don't dox myself and my account information. That would be important. All right. Schwab. Uh, what do I consider a candle wick that wicks into a fresh OB? I'm not sure what a OB is. You'd have to maybe explain that. But I don't really do a ton of technical analysis or candle analysis. Never something that's been my strong suit. I'd say my strong suit is more so forming an analysis behind the trade. And sounds dumb, but like trying to predict the future. And obviously, you're going to be wrong a lot of the time if you're trying to predict the future. But I like to trade based on unlikely events happening and kind of reaping the benefit of if that actually plays out, then you get a handsome reward. And of course, you're going to lose a lot of the time, but it's just the nature. Order block. Yeah, so I'm not too sure on candlewick analysis and order blocks. Again, like technical analysis isn't too much my strong suit. Why is my Thinkorswim just not loading? Ugh, this is awful. Hi, Gudu. Or is it Gouda? Not Gudu. Welcome. If you have any questions for me, just type them in the chat or you can speak them out loud. Whatever you're most comfortable with. Dude, why is my Thinkorswim just not loading at all? There we go. 3 years later. My bad. Okay. Probably gonna have to do two-factor authentication. Oh, another big win that I've had of mine recently has been investing in crypto. So what I've been doing in crypto for the past, I guess, say like 3 months or so, 6 months, somewhere in that timeline, is just buying any time that you have a consolidation period. That's how I built up a majority of it. It's taking years to log in to Thinkorswim, man. Yes, just let me log in the damn thing. All right. But yeah, stop losses for selling puts is what I'm trying to get to. And let me share my screen for you. Window. Entire screen is probably best for me. Let's see, stream is still running. Let me turn the OBS back on for display capture. All right. And back to Thinkorswim. Please just let me log into my Thinkorswim. For the love of God. Thinkorswim is just not working at all today. Ah, there we go. Thinkorswim on a MacBook is probably the problem here. But yeah, so if you're going to sell a put, let's say that, obviously not investment advice. We're going to do something like SPY, something simple. All right, so right now, for example, SPY is trading at $511. I'm going to sell a put. Let's say I want to buy SPY for something like 500. So scroll, go to the trade tab, find the SPY option. All right, SPY. Let's set the expiration date 5 days out. Doesn't really matter in this case. And then scroll to the 500 put. So we would sell this option for $50 single. And once that is actually performed, if we want to set a stop loss on it, let's say we want to have a $20 stop loss. This option is trading for $50 basically right now. Technically 48, 49 based on the bid ask. But let's assume that it's trading for 50. We would sell this option, right? Initially sell this option and then move up the price under this tab, which is the active trader tab. So if we wanted to have a $20 stop loss, we would set a buy stop at 70. So again, we would initially sell it for 50 and then set our stop just by clicking this at 70. So very, very simple in Thinkorswim, which is, again, is why I like it. But if you're using Robinhood, I feel like it's more complicated to set a stop loss on Robinhood. It's a lot more complicated, actually. I don't even think they do have stop losses, but I forget exactly how they work. It's not the same as a regular stop. But yeah, hopefully that answers your question. Thinkorswim would be the easiest way to be able to set stops. So if that option goes from 50 whenever you sell it to 70 whenever you decide you're done with the option, you would take that $20 loss. Yeah, no problem. All right. See if we can find any other questions to answer, maybe in the chat. Yeah, still holding the bag on UVixie, unfortunately. I bought it, God knows what price. I think 70 at this point, and now it's trading at 7. So yeah, don't trade UVixie and just hold it forever because you will get burned. I still think that there's going to be volatility probably in the next like 3 6 months, but it doesn't make sense to hold it for that period because you will get time decay on it, and it's gonna eat your money up essentially. But let me get rid of my. I'm sharing the screen on here. But yeah, UVixie, don't hold it long term. You will get burned by the time decay. I wish there was a volatility index that you could just be long and not get that time decay, but you can't just buy shares of the VIX, unfortunately. You can only either trade options on the VIX, which you're still going to get that time decay, or you can buy derivatives of the VIX, like UVixie, um, SVIX, all the other different mechanisms that they have for trading, or the ETFs, I guess. But yeah, I'm gonna be right back. We'll see y'all in just a couple minutes. Oh, I don't want to deafen myself, mute myself. All right. All right. Back at it. Got about 10 minutes till we start the poker sesh. See if we can find more cues. Uh, Day trades with options. Yep, that is one way. One way to lose money very quickly. Also, one way to gain money very quickly, but depends which side of the coin you're on for the day. I can exercise a leaps option not at expiry. That one's going to depend on the broker you're using. I think with Robinhood, they have a exercise button on the option page where it shows you like the price and all the different data, like the Greeks, stuff like that. There's some button on it that you can use to exercise the leaps or any option that you have. Who pays the credit for cover calls? Cover calls is paid by the buyer, the person that's buying um, the call from you. So basically, you have buyers and sellers in the market. somebody thinks that the stock is going to go up, they're going to buy the call, and they're the one that's paying you the credit if you're cover call seller. In order to place a sell call, you need to own 100 shares. You don't need to. So this is talking about the call debit spread. So whenever you sell a call in the call debit spread, you are using the call that you buy as collateral for it. So you're agreeing to buy 100 shares at one price and then sell the 100 shares at a separate price, right? So let's say you have 100 and a 105 spread. You would agree to buy the shares at 100 and then sell the shares at 105 if both of those options are in the money. So you don't need 100 shares to put up as collateral. If you were just selling the 105 call, then yes, you would need those 100 shares in order to cover it potentially, going higher. But since you have the $100 call that you're buying, you don't need the 100 shares of collateral. That acts as your collateral for you. Remember, guys, this all Uncle Sam will come down 32% and hate you in the mail when you do your taxes if you don't report it. Yeah, unfortunately. Government always wants their money. If I could be in the government, I would. That's for damn sure. Because they get paid no matter what. Crooks. So really, the only risk is selling your shares at the strike price. Well, it could have appreciated over to the price. No. So with cover calls, you also had the risk of the shares falling. So again, if you have $100 stock, or you buy a stock for $100, you sell a 105 cover call, but then the stock ends up dropping to $50, then you're taking a $5,000 loss on the shares, with part of that being covered by the premium you collected from the $105 call. So you got the credit, which offsets some of the $5,000 loss, but it's most likely not going to be enough to set up offset the entire loss of 5,000. What would you do if you are long in the option and it moves against you? Stop at a 50% loss. I mean, it really depends on your risk tolerance. Some people prefer tighter stops. Some people don't even set a stop loss at all. So, it really depends on your risk tolerance. And your risk tolerance is also going to determine how much profit that you're going to try to get out of the option. So, if, say you have 20% stop loss, and then you want to take an equal amount or more in profit, you need probably like 22 or 25% in profit in order to make up for that. So you kind of have to make a balance between that, or you can do it based on just the price of the option. You could have the equal price. Say you buy a option for 100, you have a stop loss at 50. You would want to have take profit at 150 in order to have a 1-to-1 risk reward ratio. But that's only going to burn your time because you're breaking even at the end of the day. But yeah, it really depends on how you want to structure your stop loss system, or if you even want to have one. Hi, Peter. Missing my stash. Yeah, gotta stay clean shaven in private equity and keep that professional look. So the app for this, Robinhood, most likely. Let's see how crypto is doing today. We have about 4 more minutes till we start the poker sesh. So let me check on my crypto portfolio, the only market that's open on the weekend. 12.4. So again, something that I've been pouring my money into has been Doge. I did end up moving from Doge to Ethereum. I think it was 2000 Doge, was 17 cents at the time. So I moved over $350 or so from Dogecoin into Ethereum. I think that Ethereum, the reason why I made that transfer is because I think Ethereum is going to be the next one to have the spot ETF. You're having a lot of speculation on it. So I'm just waiting on the announcement from BlackRock or Blackstone, BlackRock, whatever. Waiting on the announcement for that, and then probably right before I'm gonna end up selling my Ethereum because they're gonna have that accumulation period where um, BlackRock, Blackstone has to buy it in order to form the ETF. So you're gonna have that increased demand on top of the speculative demand, and then you're gonna have buy the rumor, sell the news potentially. Bitcoin wasn't that case, which is nice. Um, Ever since the spot ETF, the demand has gone up. I mean, I wouldn't want to buy an ETF of crypto myself. I think that it's kind of sketch, honestly. Like, it's all already sketch to put your money on a broker, or not a broker, but an exchange, like Robinhood or Coinbase, whatever. Because you saw BlockFi, I think like one and a half Ethereum locked up in BlockFi, which is worth $4,000, and around the same amount in Bitcoin, around like $3,500. So I wouldn't be putting my money again into those exchanges, any exchange. All of my crypto is held on my ledger. Not too sure what I guess if ledger software goes down, you might not get the software updates or the firmware updates. Um, and if there's any firmware updates for Ethereum, I guess you could run into some trouble there. I guess that would be the tail risk. But yeah, I've been pretty heavy into crypto recently. It's making up about half my portfolio right now.